Hey guys, and welcome back to the Value Investor Show. Today I want to speak about a stock that I'm up 20%, and this stock is about to triple. I'm going to explain exactly why and which stock that is. So for today, I want to talk through my portfolio performance overall year to date. The stock that I'm talking about is none other than Deckers Corporation. I want to take you through the stock and why the stock will triple from here, as well as go through the intrinsic value with you guys. As always, I want to thank you for the support, for the donations, for the likes. It goes beyond words. I put so much time and effort to put these videos together. Thank you guys for everything that you are doing, that pushing me to put more videos. So my stock portfolio is up 23% year to date compared to 10% for the S&P 500. I have consistently beat the S&P 500 over the last 3 years, performing exceptionally well with some investments that I have been making over the last 3 months, including Deckers Corporation. So I have been buying Deckers for a few months now. For over 1 month, I have made a few videos on Deckers explaining why this is an opportunity of a decade. This is a stock that has been beaten out by Wall Street, and I realized that there is a massive opportunity here for retail investors, and that's why I have invested in this stock. For those that don't know, Deckers brands includes brands like Hoka and NAG, which are the two primary brands that make Deckers Corporation, roughly making 95% of its revenues, and they also have a few other brands that only make 5% of the rest. So Deckers is now up 20% since the drop they had in mid-August. I was buying quite heavily here, and I have been investing over the last 1.5 months at an average price of roughly 101 USD. In fact, the stock is now down 41% year to date. There is fear that Deckers is losing market share in the US, and there is fear around tariff impact, which is costing the bottom line, the profits. However, Deckers has double beat the Q2 earnings while signaling a cautious stance for forward year 2025, which investors didn't like. Upon beating double earnings in July, the stock skyrocketed 25%, but then it dropped back to 100 levels, and now it's back to its 120 levels. So there's still a lot to discuss for this video. So as I said, I'm 18% up. I have been investing since July. July is when I entered this position for the first time at $106 a share. Then I bought again at $95 a share, and then again at $101 a share. I still think that the company is undervalued, and we're gonna talk through the intrinsic value in a second, but for now I'm really happy with my position. I'm overperforming the S&P 500 and Deckers. I do think that this is an opportunity that could double or triple over the next few years. Deckers is a company that have been very consistent in the past, double beating estimates every single time. They beat estimates last quarter, they beat estimate over the last 28 quarters since 2018, and generally the management tends to provide lower expectations. They tend to lower expectations in order to beat them, and that's what they did this year as well. There has been a leadership change. The CEO changed this year. Given the cautious stance that the management has shown, investors have been a bit cautious, but the CEO has shown, the management has shown that Deckers is still very strong. They double beat estimates again, and I expect them to do so in the future again. In fact, for the first quarter of 2026, they had a very strong result. They have 1.7 billion in cash. They have zero long-term debt. Their net sales have increased almost 20% year to date. Their net income as well has increased. Their EPS has increased, and they have been buying back shares as well. So overall, very strong. Deckers is now trading at historic lows compared to the historical price to free cash flow yield. This shows us this stock has dropped significantly while free cash flow has been increasing as well. So one of the main risks, one of the main things that investors are cautious about is that US demand is falling off. However, I do think that this is dead wrong, because yes, quarter to quarter US demand has decreased, but US sales are still up year on year. At the same time, international sales are up more than 20% year on year. So I do think that the opportunity lies elsewhere for Deckers. Yes, this is a US company, but at the same time, they operate internationally. And Deckers brands, for example, Hoka and NAG, are international brands. They're known quite well internationally. And the fact that it's growing at this pace internationally shows that there is a lot more upside in the near future, in the next 2-3 years for those brands. I'm not too bothered about US sales stagnating, because that also also is because of economic conditions, because disposable incomes are reducing because of higher interest rates. And therefore, the fact that the company is growing internationally, it opens into new markets and new opportunities for revenues and profits to increase even further. In fact, the CEO and the CFO said in the earnings call that they will see more improvement coming up, especially in international growth. They have said that tariffs have been mitigated in the US for now because they have used inventory before tariffs, and they have hiked prices where possible to mitigate this impact. So two of the main risks are already being mitigated. As I explained as well, they have given a cautious guidance for 2026. They don't want to show a clear guideline of how 2026 could materialize because they want to see how the consumer will react to tariffs. And as we said, they want to downplay the situation. They want to beat earnings. So they're trying to have a cautious stance. They prefer to lower the expectations of the investors for now and then beat estimates as they have been doing for the last 7 years. They have talked about localization. They're investing in localization of content. In fact, if you see, they have a lot of Instagram pages depending on where you are in the world. If you're in Europe, in the US, in Asia, they're focusing on the community. They're trying to build out a community and push the branding through that. And I think that's a very good step because branding is the most important thing when it comes to especially apparel companies. And they continue to invest in their brands. They have a very, very good balance sheet. They have a strong cash position, especially if you compare them to competitors. They have zero long-term debt, zero short-term debt. This is a fantastic company, a very healthy company that is growing at 20% year on year. And some investors are just starting to understand. Here is an article that shows that Deckers is an irresistible bargain. There has been a rating upgrade. The specific investor upgraded the Deckers to a buy with a 129 price target. The stock is now trading at a little over 12 times earnings. Is projected FY28. Over the medium to long-term horizon, Deckers' revenue trajectory is promising, especially as international markets outpace the US with targeted product innovation and channel strategy both for Hoka and UGG. So investors are just starting to understand that this is a massive opportunity for them, and Deckers is indeed an undervalued company with very strong fundamentals. In fact, my financial analysis, my financial model. Before we dive into the rest of the video, I want to thank today's sponsor, Fiscal AI. If you're serious about investing, this platform is a game changer. It gives you beautiful, clear graphs with all the KPIs you care about in absolute numbers and percentage changes. It has powerful forecasting tools so that you can project performance and even calculate a company's intrinsic value. It has industry benchmarks so you know exactly how a business stacks up, and it has detailed equity research papers with everything you need. Above all that, it's all integrated with AI so you can leverage AI in every part of your analysis. This is honestly a no-brainer platform. I use it every single day, and for a limited time you can get 15% off using my link in the description and pinned comment below. Don't miss it, sign up now. It's currently showing that the EPS method, the intrinsic value of the company, is $173 a share. So it's significantly more than the current stock price of $120. The DCF method with 15% margin of safety shows $96 a share. So that's an intrinsic value as well of roughly $180. The historical growth of this company is nothing but outstanding. I've used a 25p ratio, which is the 3-year average, and for my assumptions I've used 9 to 12% growth, which is much less than the historical growth because I am accounting for less US demand and regardless of the international expansion. So overall, this is still an undervalued business. It really depends on your margin of safety, but with my margin of safety of 50%, discount rate of 8%, this is an undervalued business. Am I buying or am I selling? Well, I'm currently very happy with my position. I have a significant position in Deckers and I'm extremely happy with how earnings turns out. I'm happy with the stock itself. I am very long on this company. I am going to hold for the next 2-3 years. I even own Hokas myself. I love the shoe. It's a fantastic shoe, especially for running. If the stock drops back again to $100 to $105, I will buy more. But my view is that we will see analysts raising their 12-month price targets as the stock increases, as there's upward pressure on the stock. I do think that Wall Street and analysts will come with higher ratings, which will boost the stock further. And I do think that we're just at the start of where this stock could go. This is a very significantly undervalued stock. That's everything for today. Thank you so much for the support, and I'll see you in the next video where I will talk through Adobe. So please subscribe if you haven't, and I'll see you guys in the next one.